Well, welcome everybody. I am Doe Wright. I'm a professor at UMKC, and we are going to talk about taxes in crypto for the next 50 minutes. So, we're not going to cover the entire waterfront of crypto because you can't cover the entire waterfront of crypto in 50 minutes, and especially after lunch because people are a little sleepy. We're going to cover the tax basics of crypto, exactly how you deal with how to report crypto information and what that information is. Then we're going to talk a little bit, a very little bit about planning opportunities, some of the more common, easy, non-controversial planning opportunities that exist in crypto. I'm not going to get into the more complicated stuff because generally speaking you have to pay me for that information. Next we're going to get enforcement. As you know from my bio, I used to work with DOJ, so I'm very familiar with the enforcement side, particularly on the tax side, and what's going on right now in enforcement, and some of the big constitutional issues the government has introduced or is treading over with the current level of enforcement in crypto and crypto tax. And finally, we get to some issues on the horizon with respect to crypto, particularly with the infrastructure bill that was just passed by the House yesterday, and now that it was passed by the Senate, I think in the summer, it's just waiting for a signature by the President, and that's going to be law. So, right now, the IRS treats crypto as property. And that was a very important thing, and that happened in what is called Notice 2014, I think 2014-21. The IRS issued a notice and they said, we're going to treat crypto not as a currency, but as property. We're not going to treat it as a stock, but as fundamentally as property. And what that meant was, anytime you change the species of your crypto from one crypto to anything else, that is a taxable transaction. And before 2014, no one knew exactly what the rules were for crypto because there are a lot of different possibilities. But the IRS in that notice said crypto is property. Now, one interesting thing about the fact is it was issued by a notice. A notice is simply the IRS saying, we think this is right. There's no regulation, there's no statute, there's no nothing. It is just the IRS saying, yeah, we kind of think this is right. Thank you. And so, that gives the IRS quite a lot of flexibility with respect to the rules. Because when you're thinking about fighting the IRS, you only fight if they come after you. And that gives them a lot of discretion to say, hey, we're going to set this rule. We might not enforce it, but 99% of the people are just going to do exactly what we say because we're the IRS. Right? And so rulemaking by notice is particularly problematic from a justice standpoint. You don't want an agency, an unelected agency, basically being able to say, hey, we think this is a good rule. Let's put it on everybody without going through the process of notice and comment. And notice and comment is the process that most regulation has to go through before it's enacted. The IRS kind of said, no, we're just kind of figuring this out. And they said problem. And it's stuck. No one has really attacked that. And the only way to attack the IRS is for the IRS to first come after you and then you fight back. But the IRS is not going after anybody for this. Right? And the reason you can't go after the IRS is there's a law called the Anti-Injunction Act. And that means you generally can't sue the IRS for doing something wrong unless they came after you first. So if they came out with a crazy rule, and you're like, yeah, this is our rule, you can't just say, hey, court, stop this. You have to wait for them to come after you. Right? And so these are the taxable events. Buying anytime you use a goods or service, you see what's not a taxable event. And those are kind of what you would expect, right? If I move my crypto from wallet 1 to wallet 2, and they're both my wallets, it's not going to be taxable, right? Donations, etc. The IRS said, well, what about a fork? And you know, I think all of us, well, if you're familiar with crypto, you know about two big forks. The Bitcoin forks, where Bitcoin, you had Bitcoin, and then you had Bitcoin and Bitcoin Cash, garbage. And then when Ethereum forked, and you had Ethereum, and then New Ethereum and Ethereum Classic. Well, the IRS wrote rules that said, well, the value of the new coin is all income to you when you get it. Now, with the Bitcoin fork, the new coin was Bitcoin Cash. So you're like, well, okay, that kind of makes sense. But if you go back to what happened at the Ethereum fork, the new coin was New Ethereum. So all the value of your Ethereum theoretically was taxable after that fork. The entire holdings of Ethereum. Your Ethereum Classic wasn't taxable. But nobody cares because nobody wants Ethereum Classic. Nobody uses Ethereum Classic. Horrible rule, but that's the rule. Airdrops. The IRS says if you get an airdrop, it's taxable when you have dominion and control over it. Yeah, but that rule doesn't make a whole lot of sense. Exhibit A. Somebody gave Vitalik Buterin a bunch of Doge. Why should he have to pay taxes because some idiots gave him a garbage coin? That's the rule. I'm not a big fan of Doge sheep. Just gonna say that out front.
Neither are we.
Perfect. Yeah, garbage. Absolute garbage. Right? So here's a great example. And you know, I use this one because I just have gone through a divorce with Starbucks, and you know, lack of caffeine has changed me. But if I decided I wanted to buy a venti Frappuccino for 0.0001 Bitcoin, and that is about the right price. Right? That's about the right price. Guess what? Taxable transaction. I have to report that on my income taxes. Right? Two big problems. One, how do you keep track of every time you go to Starbucks and buy a Frappuccino? Right? Other than how big your waist gets from drinking all that sugar. And two, how do you figure out which Bitcoin you used or which 0.0001 Bitcoin you used to buy the Frappuccino? Do you have a UTXO that says, oh, this is my Starbucks UTXO? It doesn't really work that way. Now, the smart thing for Congress, and you know, in the regulatory section, what could we do? The smart thing would be to have a de minimis threshold for transactions. Meaning, hey, and they have one for foreign currencies. Like if you go to Europe and you get some euros and you come back and guess what? Your euros have appreciated in value. You don't have to pay tax on that appreciation in value because Congress said you don't. There should be something like that for small transactions. However, and this is one of the times where I'm on the IRS side, they didn't come out with a rule that says that because fundamentally they can't. Congress is the only party that can do that. If the IRS comes in and says, hey, we're going to change this law, we have another problem because we have a regulatory agency making law. I'd rather them defer to Congress than just make up laws as they go along. And so that's why we have a note on that. And so how do you figure out what is your cost basis of Bitcoin? And your cost basis is how you determine whether or not you have taxable income. It's the amount received minus your cost basis is your gain, right? And so if you bought Bitcoin for 1,000, you sold it for 60,000, you have your basis is 1,000, your amount received is 60, you have $59,000 gain. Fairly simple. However, if you are like what I advise my students, some of whom are here, hey, buy a little Bitcoin every week. Don't try to buy it all at the dip. You're not that smart. You just keep buying it forever. How do you figure out which Bitcoin you're using when you buy that Frappuccino, right? It's very hard to figure that out because if you bought all over this period of time and then you sell it, which one am I using? And when the IRS said in 2014, hey, this is our rule, And everyone in the tax community said, what about basis? They were like, that's a good question. It's a really good question. I'll get back to you. All right. So that was kind of what they said. I'll get back to you. And the IRS, in government fashion, they did get back to you. They honored their word. In 2019, they got back to you. 5 years later, they said, you got to use LIFO, which is last in, first out, right? The last Bitcoin you used. Or you can use what's called specific identification. You can say, I'm using this Bitcoin for this. Now, it does, at least they gave taxpayers the flexibility on this. They said, hey, this kind of makes sense. Right? So now we get to some crypto-specific issues. We kind of talked about forks already, and the horrible rules we have for forks. Airdrops, kind of talked about those. I do this all the time. I step on top of my slides because my brain gets going faster than my mouth. Right? Mining income. Mining, like if you are mining Bitcoin, what is that? Well, the IRS basically said that's going to be treated as ordinary income. Meaning, the same way you get a salary, what you do for mining, you're going to be taxed on that as soon as you get those coins. But you can deduct all your costs associated with your mining activity. So, in effect, they treated it kind of like they treat everything else. One other issue that came up is 1031 exchanges. And 1031 exchanges basically are a way, if you can take one asset, exchange it for another asset, but use your basis from the first asset to the other. For example, the example that is most often used is, I buy a house for $10,000, it's now worth $100,000. I can transfer that house for another house worth $100,000 and not pay the tax. That's the 1031 exchange. And so there was a question of, well, if I bought $1,000 worth of Bitcoin, now it's worth 60, can I exchange that for $60,000 worth of Ethereum? Say you wanted to do it for some reason. Or let's make it even worse. You wanted to exchange it for Doge, right? It's stupid, but you're free to do it. That is the beauty of freedom, right? Before 2017, that was an open question about whether or not you could actually do that, right? Because the IRS rules are kind of fuzzy about that. But on June 18th, the IRS said definitively, at least they came out with their position, and he said, no, you can't do it. And part of it is because, well, and that's why I said 2017 initially, because in 2017, that act passed, and that said definitively you cannot do a 1031 exchange using your crypto. By the way, if there are questions, feel free to interrupt before we, okay, perfect. Yes.
Let me pick from like 5 questions that are already written down. No tax professional has stopped me from doing FIFO, and I've been reporting FIFO for probably the last 5 years.
Okay.
And my understanding is like when it comes to paying taxes, like you choose LIFO or FIFO and you stick with it.
For most things, the thing about, quite frankly, and I'll say this as someone who's worked at DOJ and worked with the IRS. I was in DOJ tax. As long as you are consistent, you probably have nothing to worry about. Because the IRS is not, the IRS is not concerned with people who are like, I'm choosing something different. They're concerned with, I'm not paying any taxes, right? And so, whatever you choose, you are probably okay. Because again, they didn't do that through rulemaking. They did that through a notice, and quite frankly, I think they did that through a Q&A associated with the notice.
That leads to another question, and then I'll stop with them. What other assets currently enjoy notice but no comment status?
Very, very few sophisticated assets, right? Notice rule, let's just say, I got my start in tax in a time when, let's just say, some fairly wealthy people were doing things that would allow them to avoid taxes using derivative products. I don't know if you remember the kind of the 90s and some of the huge tax shelters. Well, my firms were generally the people defending these scofflaws, right? And you know, my clients were terrible, right? They were evading taxes, period. But they hired us to come up with some reason that they shouldn't be prosecuted. And they're rich, so they got away with it, right? They used notice rulemaking at that time because, again, generally speaking, the IRS is overwhelms most taxpayers, but they can't overwhelm rich taxpayers. And so you have to rely on something else, like notice rulemaking, to give you more power in that fight. Okay?
So to follow up on the FIFO, LIFO, you mentioned the specific allocation. From what I understand is if you choose that option, you can't commingle funds. There has to be a separation, or clear separation. But my question is this: how do you report that on your taxes? So I understand there's like I forget the form number, but capital gains, losses. But how do you submit multiple forms of those, one for each wallet, or how does that work?
Practically, you can submit it any way you want that justifies it. Because it's really the question of if they come in looking, what do you have to justify your position, right? You don't have to say, I'm going to give you 8,000 pages of records. You can say, hey, fundamentally, if you said I have this much gain from 1,000 transactions and I have records that say my average basis is 2,000, no one's really going to come after you. Now, I can't say that officially, right? But fundamentally, the IRS cares more about you reporting, as you'll see in a couple of slides, than in how well you do.
In your experience with this litigation and all those things going on, did you notice anything regarding politically motivated pressure on people?
Not one item. DOJ tax is protected against any, at least when I was there in the Bush administration, absolutely no political influence. And quite frankly, if it was political, we had to go through so many extra layers of scrutiny to do anything. Like, if it even smelled political, they're like, okay, AG's got to sign off on this because we can't just go after politicians.
What do you mean when you say political? Sounds like you're talking about something.
If it was related to any politician at all.
Right, no, I'm not referring to politicians.
Oh, okay.
No, I'm talking about political pressure. For instance, if you're a conservative, if you have different types of things that go against, like for instance, the government, like for instance, you're working on something that is kind of reducing the power of the banks in some way. And like there's been countless examples of how they kind of go after certain people. So you're only referring to political, in other words, politicians.
No, in DOJ tax, absolutely not. We went after people who cheated, fundamentally, and that's it. And we went after people who cheated on a large enough scale that we could, if we went after them, everybody else would think twice about doing it. There was no political influence. None. I did meet the AG once, and I was like, wow, he didn't tell me what to do. Yes?
Yeah, just on an aside, a U.S. attorney can't bring a criminal tax charge, right? It has to be signed off on by main justice.
Yes, if you want to bring a criminal tax charge, you have to get signed off by us, my former us, being DOJ tax. Because fundamentally, line prosecutors at a U.S. attorney's office generally don't want to do tax cases, right? Because they're hard, they're paper intensive, they're used to what happened next officer cases, right? We do cases where we have 800 documents. They're like, I don't want any part of it. And so that's one of the reasons. Plus, we have that special expertise because the only way you're ever charged with a tax crime is if you try to commit it. You can't do it by accident. period. You cannot be convicted of a tax crime by accident. And I'll give you one very quick anecdote. You guys are like used to this. Right before I left, I almost had a chance to prosecute Wesley Snipes. Right? And if you remember Wesley Snipes, he was a huge tax cheat. Right? And his argument was, well, I made the money in another country, therefore the US can't tax it, which is a ridiculous argument. Right? US taxes income worldwide, period, full stop. That's the law. His argument was, well, I got some lunatic attorney to sign off on this foolishness. Unfortunately, right as I left, they gave it to somebody else, the worst prosecutor in the office. Literally. Somebody you do not want to put in front of a jury, because I like talking to juries. I tell jokes. I do all that. Basically, to be a good litigator, you have to entertain, right? And so I do my thing. He got off, even though, and he got off because he had this one lunatic attorney who said, yeah, you can do it, even though all the big accounting firms he hired said, no, this is stupid, you're going to go to jail. So when I say he got off for the felonies, but the judge was so incensed, he was convicted of misdemeanors, they sentenced him to 3 consecutive one-year terms for misdemeanors, which never happens. Never. If you get a misdemeanor, you get 3 misdemeanors, they're gonna generally put them all in 1 year, you're done. Judge was like, I can't believe, and it was like $20 million of taxes, right? I don't even know how I got off on this tangent. Right, but that's kind of where we are. Yes.
So just to make sure I understand this, if I bought $1,000 worth of Bitcoin in January, and let's say it grows to be worth $10,000, so now I have $9,000 in profit. I swap that to Ethereum. I'm required to report that gain of $9,000, even though it's now in a different asset.
Yes. The same way if you bought a Picasso for $1,000, it was worth $10,000. You exchange your Picasso for a Basquiat. Yes, you would have to pay tax.
This is what's known as like-kind exchange, right?
It's a like-kind exchange, but there's
Well,
no
the
exemption for
opposite
this.
of like-kind.
Right. Yeah. Well, the like-kind exchange, it's still a like-kind exchange basically, but it's not. It's a taxable like-kind exchange, and except for real estate, all like-kind exchanges are pretty much taxable. But I love answering questions, so feel free.
Are you currently training up people to become experts in this? Because as we try to seek experts in the marketplace, they're not out there. We're glad you're here and you got students here at GasBank. Are there smarter people coming onto the market able to serve us?
Well, here's the thing. I've been at UMKC for what, 4 years now? I am finally getting to teach tax again. They hired me. And they're like, you can teach tax once somebody retires. I really want to teach tax. I'm like, yeah, but we need you to teach biz orgs. I'm like, I hate teaching biz orgs. Right? So the answer is not really. My students get this. Like, I make crypto part of every class I teach. Am I right? Yeah. Every chance I get, I talk crypto, I talk this. But,
You said it, not really.
Yeah, not really.
And so what I was going to say, what our ask was, in the gross basis, right? So someone that trades a lot is going to have a lot of entries and exits and a lot of entries and exits, right? So how complex of, I would say, like proof of work, how it needs to be shown to say that, like, the exchange is going to send you, it's happened to me, the exchange sent me a gross receipt for all sales, right? But that did not represent the profit that I made in trading. So I had to go back and prove all 59,000 trades that I made last year at the basis that I made them and had to turn in a massive document. I still got hammered for taxes because it made me money, but the point was that it was my argument the whole time was that it should all be taxed on the net. So at what point is the IRS or whoever going to require the exchanges themselves to create that vertical level of information?
Believe it or not, we're getting there. Right, because it's increasing, particularly with what happened today, yesterday when the infrastructure bill was signed. That's more and more part of this because they're going to put more of the onus on reporting on the exchanges. Now, they can only do that with the centralized exchanges.
Right.
You can't do that with the DEX, right? You're like, yeah, good luck trying to get a 1099 from a DEX. Right? So, yes.
So I want to push back on the issue of you can't be prosecuted for not knowing. So the new infrastructure bill that was apparently passed last night, if I understand it correctly, it modifies the tax code IRS 6050I.
I hear you, but let me get to that slide.
Okay.
Because I have that on the slide.
Cool.
All right. So we're going to talk briefly about planning opportunities. All right. Tax loss harvesting. I don't know how many of you know about tax loss harvesting, but it is something you need to know about if you have crypto. Because right now, you don't have this rule. Not saying how long you won't have this rule, but right now you don't have this rule. And what this basically says is if you have, big gains and losses in something, you can sell your losses in something, capture that loss, and then buy it back the next second. Well, I would say buy it back the next day. There's a reason why I say buy it back the next day. If you have to buy it back the next second, go ahead, but you're probably better buying it back the next day, right? And the other thing is Puerto Rico, right? And if anyone needs me to do a fact-finding trip to Puerto Rico this winter, I am all for it. I will happily do that for any of you. That is my gift, all right? So what tax loss harvesting is you combine your gains with losses to reduce or eliminate your tax bill, right? You have, one of your, I don't know how in this market you could have a down position, but let's assume that you have a down position, right? You're like, oh, I'm gonna sell it on December 31st, I'm gonna buy it back on January 1st, right? And I'm gonna monetize that loss to offset other gains. Perfectly legal in crypto, right? Because there's no wash sale rule. The wash sale rule basically says if you do just that, within 30 days, the IRS can disallow the loss. They can say, no, all you're doing is effectively trying to do that, and you're doing it very efficiently. The IRS said, no, we're not gonna let you do that. However, there is something to worry about. It's called the Sham Transaction Doc. This is the IRS's backstop for anything that they are like, this is just too aggressive. Theoretically, if you are doing the 1 second wash sale, they could, I'm not saying they would, they could say that's a wash sale. And you only did that if the only reason you do something is purely for the tax reasons. The IRS has that in its quiver that they can say it's a sham transaction, there's no economic substance, they can ignore the transaction. The law basically, or at least the way the case law has come out, 1 second is not enough, but 1 day is. So, and as another phrase I always tell my students, when thinking about this, pigs get fat, hogs get slaughtered. Right? Don't be too greedy.
Can I add that little section right there? So there's a famous technique where people get their wallets hacked and they lose their money. Are you familiar with that?
I am not familiar with that one, and that's one of those, I'm going to close my ears and say, la, 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 unless we have attorney-client privilege.
Right. Okay. Enough said.
Right. Puerto Rico. Okay? Zero tax on passive income. Capital gains count as passive income. Regular income is only taxed at 4%. Right? But you have to move to Puerto Rico. I don't know how many of you are familiar with the Bad Crypto podcast. One of the guys used to live in Kansas City. I was actually on that podcast a while. Both of them have moved to Puerto Rico. Right? Why? This reason. Right? You have to stay 183 days. I'm trying to figure out how I can do that and still teach at UMKC. Is this possible? Can you do that? Right? Or you can buy real property, can't have a tax home anywhere else. But there is a but, and there's always a but. It only applies to the gains you receive while you're a resident of Puerto Rico, unless you've been there so long, and I think it's 10 years. After 10 years, they relax that rule. So if you're gonna hold your crypto for 10 years, then you can take advantage of that rule. Now, you might say, well, that's a long time to hold it. Well, that's why you use derivatives to basically monetize your position without actually selling your position. Estee Lauder did this quite a few years ago to basically pay no tax when she passed all of her wealth to her kids. She just said, oh, I'm gonna short my entire position. And if you have a long and a short at the same time on the same assets, guess what? You've effectively cashed out. And that's what she did. Yes?
So this is not an area of the law I'm very familiar with, but South Dakota is the nation's top tax haven because of their trust laws. So like, can you put your crypto in a trust? And how does that?
It doesn't. Right? A trust is not going to defeat it because all those trusts are fundamentally grantor trusts. And a grantor trust is going to be ignored by the IRS. Like, you do not want to go in court and say, oh, I put it in a trust that I control and try to win anything. Right? The only thing those trusts are really good for is trying to protect it from your spouse who may not know about it. Again, that's as far as I'm going with that without attorney-client privilege. Yes?
So is that recently though that they've come under more attack on? It was the wing trust or something. That's what they called it. It was I tried this. Okay, so I'm just throwing this out there. I explored this possibility, and the people, the lawyers themselves were like, you will actually make yourself a target by setting this up.
Yeah.
As a resident of not this place.
Yeah.
You know, and they were very bearish on that as a structure. You know what I mean?
Absolutely. And I can tell you, it's just like setting up a Cayman Island company 20 years ago. If you set up a Cayman Island company, you put a red flag on yourself. Like, oh, Cayman Islands, I wonder why you moved to the Caymans, or I wonder why this business is in the Caymans. You didn't go there for any other reason except to avoid taxes, so now we're gonna look harder.
Can you own and transact with your crypto underneath a business umbrella that lets you offset business expenses against it?
Absolutely. Absolutely. Crypto expenses are completely deductible. Right? You know, well, I'll give you an example. Some of my clients pay me in crypto. I actually prefer that. Like, please pay me in crypto.
So I didn't, but let's say I traveled out of state for this event. I had business expense, I had tickets, I had lodging. How would I structure myself in order to do that?
Well, that's a more complicated question because it depends on a whole lot of factors.
You told us at the beginning, we got to pay you for the complicated answer.
Right. I mean, generally speaking, if you have a legitimate business and you are doing something to make money, and you know what is a business is coming up in a couple slides, right? You can deduct the costs associated with how you make that money. My wife is a quote-unquote partner in my law firm, even though she does nothing with respect to the firm. However, if we actually go out to dinner and have talk firm business, that's deductible meal. Now, she doesn't want to actually talk business, so I don't deduct that often, but theoretically it's true. Right? But one of my new associates, we're going to have a retreat in Puerto Rico to talk about business. Guess what? Completely deductible. And we actually are going to talk about business. We're not just going to play golf. Okay. So here's kind of the why the IRS has been doing so much more, particularly with what happened with the infrastructure bill. The tax gap. The tax gap is roughly $600+ billion. And that's the difference between what people should pay and what people have actually paid. And you can see that number is going up. And crypto makes it way easier to do this. We can't say, oh, the government's just being like, oh, they're going overboard. Reality is, we all know that crypto is easier to avoid taxes with crypto than without. So let's be honest. we know that there's a tax gap. We know the government has an interest in collecting the right amount of tax. You can have arguments about whether taxes are constitutional or all that, but like, we've had those arguments. They haven't won. You decide to stay in this country, so you know that you gotta pay taxes, right? And that's the rule, right? And so what we have is a $600 billion tax gap, and over 10 years, that number is expected to be around $7 trillion. Right? And so the government has to do something to try to get that money that is being underreported, right? And if we look at it, a big part of that is underreported, right? Like when my clients pay me in crypto, I know I have to report that. I can't just be like, well, you send it to my crypto account in my offshore crypto account, so therefore, it's not really taxable income. Like, I can't get away with that fiction. One, because I'm a lawyer. Two, I used to work at DOJ. And three, I'm like, it ain't worth it. I like living in a free society. That's the cost. And so, you get into why the government has done that, right? The other part of this, starting with Reagan, is basically they have cut so much money out of the IRS budget that the IRS can't even do its job well. And when you cut so much money out, the IRS starts doing blanket stuff because they can't do the specific stuff, right? If you tell me, well, I'm gonna hamstring you and not allow you to do stuff, then I'm going to pass a rule that's ridiculous because it's the only way they have to actually get the money they need, right? And so what you've seen is, and you know, roughly every dollar you cut from the IRS costs $4 to the fiscal, right? And those dollars have been cut since Reagan. The Biden administration has said they are going to increase the IRS budget and they're going to start auditing more people who make more than $400,000. Because right now, if you make more than $400,000, your audit risk is somewhere less than, I think, 0.5%, right? And they're also the biggest scofflaws with respect to not paying their taxes. That I know from being at DOJ, right? And so, again, fair taxes, okay. Unfair taxes, problem, right? But these are the numbers, right? And again, the audit rate for millionaires has gone down 61% over the last 10 years. That's a problem because we know the millionaires are the people who are cheating on their taxes. I mean, it's a reality. If you own your own business, you have so much discretion about when or if you are going to report. And again, you can, all kinds of arguments, you can, quite frankly, if you are willing to hire a lawyer, you can legally pay very little in taxes, right? And you know, you look at Jeff Bezos and all those other people, like, why do they only pay this? Like, yeah, well, guess what? They hired a lawyer to figure it out. You can play by the rules and get a low tax rate. You can't cheat. So now we get to the other side. That was me on my pro-government side. This is me on my anti-government side, all right? John Doe Summons. How many of you have ever heard of a John Doe Summons? Okay, a few. What? No, you should. You go to law school. A John Doe Summons basically is a summons where the IRS said, hey, institution, send us all your records so we can figure out if anybody's done anything wrong.
Coinbase.
Right? You're jumping ahead of my slides. Yeah, come on. Right? Right? So, in effect, it's a fishing expedition. They're getting all your information like, hey, Citibank, send us anybody's information who's sent more than $50,000 to the Cayman Islands. The government can't do that, right? Because we have this little thing that we've come to love called the Fourth Amendment, right? And it says, no warrants except on probable cause. The government has to have a reason to get you to turn over information. They can't just say, give us everything and let us figure out if you did anything wrong. And again, particularly describing the place to be searched and the person or things to be seized means you can't just have a general John Doe, hey, Coinbase, send me everything you got, right? But that's what they did. Yes.
Question, I think in 2020, the tax reporting software started to ask, like, number one question, do you have digital currency?
You can't jump in front of my
all
slides.
right.
Gosh.
Oh, wait.
Right. So we get the Coinbase. We get this Coinbase issue. And this is the question they asked. We want accounts of anybody between those 2 years who bought, sold, sent, or received at least $20,000 of crypto. Right? And the court said, yeah, sure. Right? Now, why? The tax gap. Because the IRS had credible evidence that a lot of those crypto gains had gone unreported. The same thing happened, I can tell you, I was working at a law firm defending rich scumbags with the Swiss bank accounts. You remember the Swiss bank accounts where all of a sudden we could never get information about Swiss bank accounts, and all of a sudden we had an agreement where it says, oh, we're turning over, we had these people coming in our office like, I never knew that the millions of dollars I made in Switzerland, somehow I should have paid taxes in the US on it. And we had to sit there with a straight face saying, yeah, I understand how you wouldn't understand that you wouldn't have to pay taxes on millions of dollars of income. Like, that's the game we played. Like, okay, you're gonna tell me a lie, I'm gonna tell you a lie, you pay me, thank you, right? And so that's kind of what happened here, right? But here's the problem. Here's where it gets, okay, the IRS got away with the Coinbase one. USDC. And Kraken, right? This is only the beginning. These are 2021 summonses. They're going back to their playbook because the tax gap is growing. That tax gap gives them the excuse to do more of this. And legitimately so. Now, again, we have a Fourth Amendment issue here, like, hey, wait a minute, the government generally has to know you didn't do something, not this entire group of people may not have done something. But so far, they're using this to get more information, right? So they also started sending these letters. Hello, we have information. Maybe you didn't do something you were supposed to do. These letters came out in 2019, right? And those letters were, one, hey, you have unreported crypto income? Two, you probably didn't report everything, but I'm not really sure. And then three, we know it, you didn't report it, and we're not happy. Audit ahead. Okay? But again, this is how the IRS had to respond to this. Like, what else are they supposed to do? Like, they're trying to fix the tax gap as much as they can, right? Broader enforcement. We get to the crypto question, right? And the FBAR stuff. We'll talk about the FBAR, all right? Okay, in 2019, you saw this question on a schedule to your tax return. I was incensed, as far as a law professor can be, I was incensed by this question because this question doesn't necessarily say anything about having any gains. Okay? And there's some other problems with it, but I'll get to the other problems later. All right? So this question was on your 2019 tax return. But in 2020, they said, no, let's put it on the front page. 2019, it was on the schedule to your IRS tax return. 2020, it's on page 1 right after your name and address. At any time, did you receive, sell, send, or exchange, or otherwise acquire any financial interest in any virtual currency? First question, what is a financial interest in a virtual currency? I know what ownership is, but if I buy a Bitcoin ETF, do I have a financial interest in a virtual currency? If I buy shares of Riot, Bitcoin miner, do I have a financial interest in a virtual currency? I don't know. Do you know? Anybody know? Who knows what that means?
So it's not the question of technically no, but the problem is that their interpretation of it can be anything, so it doesn't matter really what the reality is, it's what they decide.
So if I just simply made straight scheduled purchases, like through Square Cash, or Stripe, or something like that, like despite the fact that I never sold it, it's never coming out like in LIFO, I still have to say yes on that?
You're on the list. You get to be on the list.
Oh, son of a bitch.
Yes.
Are they fishing for future that if you say yes, that, well, that kind of raises a flag that potentially down the line, hey, this person might be somebody we want to watch in case they do a gain or anything like that?
They're doing the same thing Facebook does with your likes.
Okay.
I thought I saw an opinion from the IRS issued that simple purchases didn't require a yes to that.
You can't jump in front of my slides.
So if you have, I mean, that's a really broad question.
Right.
Do they do that for anyone else to say if you just purchase an asset class, you have to report?
The only thing similar is the check the box for the FBAR.
Okay.
So there's a very simple overarching thing here legally, and that is the same thing that they did with the mafia. If you lie on any paper there, then you're going to jail. So
Very good point.
So that's the only thing that you really need to do to be able to control.
Very good point. One of the things about your tax return, and every tax return you have, there is a line right above your signature that says, you are signing this under the penalties of perjury. It's called the jurat. Every tax return you sign, you are signing under the penalty of perjury to the best of your knowledge and belief. So, now the government has a list of who owns crypto. What are they going to do with it? Who knows? Does that add to their algorithm of likely to audit? Probably. Now, I was really close to writing a law review article on this because I was pissed. I was like, you can't ask that. That is none of your business. That doesn't have anything to do with whether I have taxable income. You have the right to ask me about taxable income. You don't have the right to ask me what I own. You can't ask me if I own a gun. You can't ask me if I own anything. You can ask me if I have to pay taxes on something. I had a problem with that. And I was like, I was really gung-ho about writing that article, but I was unfortunately writing a book at the time, right? And can't do two things at once. So I let it go, and then the IRS caved and said, well, if they were just purchases, you are not required to answer yes. Now, guess how they did that? In a notice. But you can't rely on it. The IRS can say stuff, but you can't rely on what they said to get you out of trouble. Right? It's the reality. Right? This is, and my students always say, I can't believe tax is fun when they come in and they're like, wow, tax is actually fun. Like, tax is fun. It's a fight between you and the government. It's clear, you know exactly who's on the other side. And you can go up to the line, but you can't cross it.
Can I put them in jail if I win?
No, not only that, you can't even sue them. Because I thought this would be a great place for a constitutional challenge on financial privacy. You have a right to privacy, no matter what's gonna happen to the right to privacy with respect to Roe. I'm not going there, that's a different show, right? I'm not going there. But This is a financial right to privacy issue. And the government, you can't sue the government on anything related to tax unless they come after you because of the Anti-Injunction Act. So now we get to the FBAR, Foreign Bank Account Report. Again, financial privacy question. How is it that I have to tell you I have an account overseas? I understand you have the right to ask me about income, but ownership of an asset, that's none of your business. Well, we have this thing called the Bank Secrecy Act, passed in 1970, right? Requires any foreign bank account holders to take an oath, basically by signing a form, if they have foreign financial accounts exceeding $10,000 in value. Now, constitutionally, how that one snuck through was the courts used this argument that effectively goes, you turned over that information to a bank willingly, therefore you don't have any more privacy rights with respect to that information, therefore you can share. That was, if you kind of think of their daisy chain of argument, because you turned that over willingly to a bank, that means it's no longer private, therefore you can tell us. That was how they passed the Bank Secrecy Act and how it withstood constitutional challenges. Right? But then, fast forward to 1984. What was going on in 1984? We had a war. Anybody know what war that was? It was a drug war. And if we want to go after people, we want to go after the money, right? So let's beef up this rule, right? And so in 1984, they're like, yeah, not only do you have to do it, if you play games or don't report it, we're going to throw you in jail, right? Why? Because of the drug war. We need as many arrows in our quiver to go after these pernicious drug dealers as possible, so let's pass these extra laws, right? And then there was 2001, the Twin Towers, and they were like, oh, now we have even more reason to go after terrorist financing, so therefore let's beef them up even more. So now you have more surveillance by the government. So here's a big question, like, well, what about crypto foreign accounts? Let's say that I was an early person in Binance, and when Binance kind of did its whole bifurcation dance, and you're like, oh, you gotta be a US. I'm like, no, I'm gonna figure out how to keep this Binance account open because I have a sister in Latvia, right? And I'm gonna do that, but it's my account. Do you have to disclose that under FBAR? Well, right now, the answer is no. Crypto accounts don't qualify under FBAR as something that has to be reported. However, Treasury just came out this year and said, we're looking at that. And you can bet your bottom dollar within 2 years, that law will be changed. And foreign crypto accounts will be required to be listed on your FBAR. Right? So, the infrastructure bill. Okay. Right? One of the things about the infrastructure bill is it changes the definition of who is a broker with respect to crypto transactions. Because, how many of you know what this is? Panopticon. Why do you use a Panopticon? Use a Panopticon if you want to spy on everyone and not know who's being spied on. And so, what that Panopticon does is basically it gives the government a whole lot of surveillance over a whole lot of things. You're going to give them a ton of information that they can fish through and figure out if you are the bad guy. That's the purpose of a lot of these rules. Right? And you look at this definition of a broker, any person who, for consideration, is responsible for regularly providing any service effectuating transfers of digital assets on behalf of another person. Could anybody in the crypto industry say they are definitely not that?
I mean, hell, you could be a lightning operator falling.
Exactly. Exactly.
I didn't hear what he said.
You could run a lightning node in which, despite the fact that you actually aren't taking custody, because you can't spend what you have, you're basically forwarding a transaction on in a decentralized network so it can get to its destination. So if I'm trying to pay you, first I get to her, then she gets to him, and then it gets to you. Every one of those people is broken, possibly into that rule.
Right, but the word for consideration.
Yeah, the IRS can argue that if you run a full node, you're violating that first one.
Yeah, this is so wide open, right? And it gives the IRS the power to go after miners, developers, takers, and others.
Well, but that's where decentralization and where no one receives consideration takes you out of the loop.
Yeah, but some people are they might get fees.
You make deliberate connections with people on the network.
Right. Right. You can get
But
fees.
you're not receiving any consideration.
You are if you're getting paid fees.
Can we define consideration?
Well,
fees?
I know, but that's what I'm
I
referring
make
to.
a fee on that, I'm like,
Right.
Right, correct. I agree, but that's why this decentralization is so important to take you out of that consideration.
yeah.
So that only that joining part, right?
Right.
But at least you're taking out of those pieces.
Theoretically, right? And so here's the other, you are required to get all this information, even if you are required to get this information. Here's what the Treasury said. It's not likely that we will target these groups. How comforted are you by the fact that it is not likely that they will go after you, right?
Oh, can you go back one, please?
Sure.
Okay, thank you.
He's gonna charge you.
I'm almost done. All right. If you don't report it correctly, you can get hit with fines. If you don't report it correctly, and guess what you need? Things like social security number, date of birth, name, address. Guess what else you can do with that data? You can use it to steal it and sell it on the dark web so you can get social security cards and all kinds of other wonderful things. So you have to fill out this Form 8300 every time you do this. And here's what's on this Form 8300. If I had this information for all of you, I would then, if I were a bad person, I would go out and get a whole bunch of credit cards. Right? Name, address, city, social security number, date of birth, occupation, country. All of this stuff you have to report every time you have a transaction north of $10,000 based on this infrastructure bill that was passed. Now granted, it doesn't come into effect until 2024, but it's out there. And it gives the IRS and the Treasury and DOJ a whole lot of power to go after a whole lot of people at will.
So let's explore that a little bit. So it gives them the ability to go after a lot of people, but the reality is they don't need to go after a lot of people. All they have to do is go after a few people and make it very well known and scare everyone from doing it.
And that's
the modus operandi. That's what they do.
Fundamentally, that's very true, right?
Doesn't kill Bitcoin.
Right. And so, and here's the thing, if you say, well, if someone asks you for the information, you're like, I'm not giving you that information, screw you. Yeah. Puerto Rico's looking better. What they're fundamentally doing is deputizing everybody else to spy on everyone else. That is realistically what is going on here, right? And you can't even structure around it. You remember in the 80s, again, go back to the 80s and the drug war. when everybody's like, or watching Breaking Bad, or any of those other money laundering trends, like, oh, we're gonna keep it under 10,000. Well, that's called structuring, right? And structuring is illegal. They made it illegal basically in '84 to go after drug dealers. So that's it. This is me. Hope you enjoyed it. Happy to answer questions. There's much time.